Welcome back to Squawk Box. Rick Santelli here live at CME HQ with the important breaking news this morning. The cousin, the CPI, the wholesale side producer price index for the month of June hitting the wires. Headline number -0.3%. That is 0.3 lower than the unchanged expectations. In the rearview mirror, significant revisions along the line. This one from 1.1 to down to 0.6. And why is that significant? Because 1.1 was basically a 4-year high, so we're coming off of that. -0.3. That would be the biggest negative month-over-month change going all the way back to April of 2020. It's equal to where we were in April of last year at -0.3. Now, let's strip out the all-important food and energy, up 0.2, less than expectations. And rearview mirror, real big revision from 0.4 up to only up 0.1, and it's significant because, of course, food and energy is going to be a volatile area here, but that's still less than expectations. Now let's strip out food, energy, and trade. Number expected up 0.3, comes out up 0.1. No revisions that I see to that 0.8 in the rearview mirror. That was basically a 4-year high. When it comes to how this one compares on ex-food, energy, and trade, well, up 0.1 would be the least amount going back to April of last year when it was slightly negative. Now, let's go year over year, shall we? On final demand headline, number comes in at 5.5. We're expecting a number over 6%. And last month, 6.5% gets downgraded to 6%. So there's another big revision from what was a 3.5-year high. And if we look at year over year, ex-food, ex-energy, that comes in at 4.7. We're expecting a number over 5. Don't see a revision to the 4.9 in the rearview mirror, which was a 3.5-year high. And finally, ex-food, energy, and trade comes in at 5.1. That's actually one of the closest numbers to expectations. We're looking for 5.2. It equals last month at 5.1. So we are continuing to be a little bit high on that benchmark, and I like ex-food, energy, and trade. The 5.1 in the rearview mirror, that was basically the loftiest number in roughly 3.5 years. So we're sticking around in that area at this point. Empire Manufacturing, we're expecting a July read to come in a +9. It comes in more aggressive at 15.6. That would be the best read going back to, April of 22. That's how weak. Excuse me. We do have a positive read that was in May. That was 19.6. That was the highest since April of 2022. Now, after all that, folks, what do we see? We see that we're hovering right around 460 in a 10-year prior to the numbers. We're at 458. 2-year was at 420. Now it's at 417. The yield curve is steepened from the 24th of June's close at 24 basis points. Now it's at 41 basis points. The flattening was taking out the easing. The steepening, of course, is to some extent taking out some of the aggressive tightening. And the reason it's steepening is because 2-year yields are a little more aggressive on a give back than the 10s. And as Peter Bookfar has been telling us all at CNBC and the world, what a great research artist he is, pay attention to real rates. They're on the rise. I still see some pressure, of course, in the long term, and debt and deficits do matter. But at least for the moment, sometimes logic gives way to market-driven aspects of fundamentals and technicals intersecting. I still see some potential for some downside, but I can't stress enough. Any close above 467, especially on a weekly basis, or above 518 in a 30-year on a weekly basis, will significantly make the upside more aggressive. Joe and the gang, back to you.